Hello, everyone. Welcome back. Well, welcome here from the enmacc offices in Munich. Thanks for tuning in to another episode of our Energy Trader Summit series. And while we are still officially on vacation here in Bavaria, we think it's time to look anyway into the carbon markets, and the ETS2 market specifically is coming. We're all in preparations, not just on enmacc side, but I think many of our clients, to get ready for this next stage of European carbon markets. And that's why we invited back to us a long-term guest of this kind of show, Marcus Ferdinand, Chief Analytics Officer of Veyt, the expert in the market on ETS2. And it's a pleasure to have him today with us. As always, feel invited to join the discussion. We'll have a short presentation to trigger the topic, and then we are open to your questions. Please use the chat, the Q&A function of the Zoom software, and I will pick up the questions and get them into a discussion with Marcus. So I'm betting on your active participation. Time to hand over. Marcus, thanks for joining again. The floor is yours.
Well, thanks a lot, Jens, for the warm welcome. Hi to everyone. I'm just sharing my slides that go through. I'm looking very forward to present our thoughts and forecasts for the ETS2, a market that's about to start. So covering emissions from road transport, buildings, and small-scale industry. So obviously a lot of ground to cover. I'm representing Veyt, so basically here responsible for our products in renewable power, fuels, and carbon markets. And many of our clients currently already use us to prepare for the market start in 27. Some of them have already started early trading with a few limited transactions. So we'll dive into this, into current prices, into liquidity, fundamental setup of the market, and of course as well our outlook for prices going forward. For those of you who don't know Veyt, we are providing carbon and renewable energy market analytics. That means price data, as well as insights into political regulatory developments, and of course, modeling-based forecasts for the short, mid, and long term. You'll find the contact details at the end of the presentation. Jens has them as well, so please feel more than welcome to reach out following the call to see how we can help you then navigating carbon markets, but also guarantees of origin and PPA markets if that's of interest. Moving into the content. So on the market framework side, I thought we'd just have a quick recap on what we talk about actually. Few key parameters. So everyone who's not familiar with how the ETS2 works gets that overview. It's an upstream system, so different to the ETS1, the EU ETS, which is downstream, which basically means it is targeting the consumption of fossil fuels in the sectors covered. So both buildings, road transport, and small-scale industry. We expect around 11,500 entities being covered, so quite a large market. With regards to the coverage of emissions, it's pretty similar in size compared to the ETS1, so the EU ETS. We will come back to that in a second as well. Quite important to note, futures market has kicked off. So first transactions have happened on both exchanges, ICE and EX. But the first physical auctions will not take place before 1st of January 2027. And this is one of the areas I think we will dive a bit into during this conversation as well. Also important, it's 100% auctioning, no free allocation, and no other means of distribution. So auctioning is the means to distribute allowances to this market. Also very important, there's no fixed price, there is no price corridor. Those of you who are active in the, for instance, the German national ETS, there is a difference here because it's going to be a free floating price going forward. In terms of timeline, so I mentioned the two exchanges. They have launched their first future contracts in May and July, respectively. We also have already the first official data in place. So the 2027 cap for the market is published. So we know that first very important data point. There was a deadline for publishing the MRV data, so basically the emissions data for 2024. And that was in April this year. But you might have heard there has been a bit of delay with regards to transposition into national law. in some of the member states. So this has caused also delays in reporting this data for all of those member states, which have currently not transposed. So there is a bit of a waiting game here. If everything goes according to plan, 1st of January 27 is the start for the ETS. There is a potential for a 1-year delay. That depends on how high oil and gas prices are, and we will come to that on the next slide. So if that if one of those conditions is triggered, we would see a delay by 1 year for this mechanism. Can already take a bit away the punchline here. We do not think that these criteria will be met, but that's something I'm going to come back to. So if then the original plan is followed, start 1st of January 27, we will see the first compliance deadline in May 2028. This is when allowances for the year 2027 have to be handed in. And then that leads as well to the publication of the first total number of allowances in circulation, the famous TNAC, by June 2028. This TNAC is super important when it comes to the operation of the market stability reserve in this market, which I'm also going to touch upon. Also there, if you have any questions to abbreviations, we're abbreviation gurus here in Carbon, so make sure you ask those questions when we have the discussion later on, or when it comes to any of the mechanisms that run this or that make this market possible. Yeah, talking about the delay triggers, as I said, 2 criteria related to Brent crude oil prices and TTF gas prices. If one of those conditions is met, the start gets postponed to 2028. So looking at the left chart first, this is the Brent crude oil price. If the price between January and June 2026 is more than twice the average Brent crude oil price during the years 21 to 25, the 1-year delay comes into play. So what does it mean in practice? Well, we don't know yet the period between today and the end of 2025, but we have a lot of data already for since 2021. That is basically the detail that we require. So far, the average for Brent crude during this period is 81.3, which means doubling this would result in an average of 162.5 US dollars per barrel. If you look into the all-time high of 144 US dollars per barrel, and this again talking about an average from January to June 26, doesn't seem very likely at all. For gas, the criteria is that during January to June 2026, the front month gas price needs to be higher than the average TTF gas price between February and March 2022. So this is data we have already. The trigger is fixed, and the gas price average would then be 108.3 euros per megawatt hour. Current market price is around 32. So gas might have a slightly higher trigger chance, but based on current prices, that seems also rather unlikely, I would say. So coming back then to conclusion, we do believe the market kicks off 1st of January 27 with auctions, as currently as foreseen by legislation. So before we start looking into how this market solves, so in terms of market balance, I wanted to provide you with a brief overview of the ambition level that we talk about. On the left side, you see the emissions covered by the ETS2 during the past 10 years, right? So you see buildings, sizable, transport, even more sizable, small-scale industry, adding the cherry to the pie, basically. But what is quite obvious here is that during the past 10 years, all those sectors together, which are covered by the ETS2, have decreased emissions by 2%. That is not very much. If you look then into the ambition level, so on the right side, you basically see the planned supply trajectory. So this is the amount of allowances that will be given out to the market through auctions, which in the way then defines the emission trajectory that has to be followed. So for the next 10 years, from 2027 to 2037, emissions have to come down by almost 70%. This is a very ambitious market. Again, the market size is similar to the EU ETS, but a lot has to happen for these emissions to come down, right? ETS2 price, one of the big elements here, but member state policies, another, and then obviously a lot of private investments that need to take place based on a carbon price that have to make this trajectory happen. So where are we today? Let's have a brief look into the secondary market trading so far. ICE and EEX launched their contracts in May and July, as I said. We have looked into price development and trading activity since then. Both exchanges now offer December 27 and April 28 maturities, so quite short-term oriented as well. First observation, besides a few small trades, no significant trading took place so far. Liquidity is basically very low. It's not a large surprise, given the first physical allowances will enter the market in January 2027. So obviously a risk on the seller side to basically provide or go into to take a position here. Second observation, if we look into the ICE prices now that you see here, so basically looking into the ETS2 price in dark brown and the ETS1 price in light brown, and then looking into the gray bars, which shows the delta between those two. I think what we can see here, in absence of liquidity, there is some sort of pegging of the ETS2 price currently to the ETS1 price when it comes to the closing prices. Quite steady development, widening spreads. But I think, yeah, probably, Jens, we should discuss this after the presentation, what it actually takes to ramp up liquidity, and also which price levels are required to unlock the sell side, because I think this is one of the big questions there. How do we bring the sell side to the market? Let's have a look into how the future looks. So looking at the left chart first, you basically see the projected emissions in the covered sectors for 27. Lion's share of emissions, the road transport sector, said that before. If we look into subsectors, it's basically cars and two-wheelers, the largest subsegment, and buildings, especially residential, being the next largest segment here. If you move over to the right side, you realize that in the near term, emissions should remain well below the cap at the start, or actually at the supply, I should say. We expect emissions, which is this green triangle there, at around a bit more than 1 gigaton, while the supply of allowances, which is depicted by the red line, will be around 1.3 gigaton. This due to front-loaded allowances. You see these blue bars there, so there will be allowances actually transferred from the years 29 to 31 into the first 2 years, especially into 27, in order to give the market quite a smooth start. But that causes an oversupply. This is something that we have to talk about when we have a look into price forecast, obviously. What's quite important is that when we do forecasting, those forecasts are based on a technology uptake model. So that leverages levelized cost data for all member states and also the major consumer options. So basically, the technology uptake model is based on the data that we collect and then forecast for different member states and different technologies. It's calibrated to historic data. It uptakes sensitivity to changes in the levelized cost of various technologies. So, for example, how the uptake has varied when technology costs have changed and things like that. And on the when you look on the left side of this chart, you basically see a cost comparison for 2030 for Germany for residential buildings on the top, which is comparing those levelized costs for those different technologies. So what we see here is that, for instance, air-to-air units sit quite close to cost parity, whereas air-to-water units face substantially higher abatement costs, right? Because Germany's outlook combines then low wholesale gas prices with relatively expensive electricity prices. When you look into cars, that's the bottom chart, we see that internal combustion engines, so ICE cars versus battery electric vehicles, deliver negative abatement costs by 2030, which basically means that the transition and the transformation towards lower carbon technology in the transport sector might happen before we see kind of a market-driven abatement trajectory in the building sector, which is quite interesting because this is where, again, national member state policies come into play that can obviously fast track those developments. Quite important as well, there's a scale-up challenge. So the market share must expand 6-fold for cars and 11-fold for heat pumps to the lower carbon alternative to stay under the cap. So if you look into this trajectory there, and you anticipate that there is real-world frictions that make such growth demanding, you see that combined with the cap trajectory as showed, there is quite a challenge here ahead for all of us. So it's quite essential that we have strong policy incentives that are kind of taking us through this pathway, which is why we have reflected a lot of member state policies, obviously, in our model, in order to reflect what is already there and what is planned on the member state side to get us there. So what we kind of then do is we have a look into how this results into market balances, right? So accounting for this abatement to take place, the market balance is expected to go into oversupply territory very fast, not because there is a lot of abatement happening, but because there is allowances coming to market relatively early on. So we have this front loading of allowances, but this front loading is taken back over the years 29 to 31, which then results into a shortage on annual level. So you see the blue line is basically the accumulated market balance, which kind of goes into oversupply super quickly and then drops to a very tight situation again towards the year 2031-32. On annual level, which is these yellow bars on the left chart, you see that the market turns from oversupply into deficit rather quickly, right? So what does it mean then? If you look at it on the right side, that's supply and emissions in the ETS2. There will be an initial surplus according to our base case modeling of 233 million allowances. And then entities start drawing into the surplus in 29 and run into annual deficits until 2034. By 2034, then abatement finally catches up and the balance moves back into positive territory, as you can see on the left side again, which is kind of obviously a super important background to our price forecasting. This happens on the fundamental side. There is one complication, which is the market stability reserve. And I'm sorry that I have to add this complexity, but it's extremely important to understand how this mechanism works in order to then solve the market. So the market stability reserve, many of you will know like a very similar concept from the EU ETS, works as a tool to basically look into the oversupply into the market and adjusting auction volumes based on that, or looking into a market getting tight and then releasing allowances back from the reserve into this market. What's quite important here, and I'm recapping the rules just for you to have them at hand. So the market stability reserve is designed outside of the cap in the ETS2. So there is basically 600 million allowances set aside, which are a buffer mechanism, right? So we do not believe that the market stability reserve will soak up additional allowances, given how the market is designed. Soaking up of additional allowances would happen if the TNEC, so the total number of allowances in circulation, would drop below this lower threshold of 210 million, right? So if the oversupply drops, that was very stupid and misleading. So actually, if the TNEC is going above the upper threshold, which is at 440 million allowances, the MSR would take allowances out of the market, 100 million at a time. And if it drops below the lower threshold, it would release allowances back to the market, also 100 million tons at a time. We do not believe that the TNEC will basically move above the upper threshold, given how the market is designed. What's also quite important to understand is that as of 2031, all allowances which are still in the reserve will be invalidated. It's quite important because the market is basically entering a very tight period around this point in time, but then it would need allowances to flow back to the market in order to buffer for this tightness. But the MSR will not have allowances basically to spend as the invalidation happens in 2031, which basically means in a tight situation, the MSR might not be able to come to rescue here. I think this is super important to understand. And then there is basically another mechanism that the MSR will operate on, which is operating as a cost containment tool. There's two basic modules or modi here. So there's an actual price level and an average price level trigger. So during the first 3 years of operation, so from 2027 onwards, if the ETS2 pricing or the ETS2 auction prices exceed 45 euros per ton for 2 consecutive months, 20 million allowances will be released from the MSR. That doesn't sound much, and it isn't much actually. So we do not believe that this will have a massive price impact. Also, it has to be said that the 45 euros per ton is not the actual trigger price. It's an index to 2020 levels price. So we talk about actual levels of around 55 euros or so in 2027. Again, it's by no means a price floor or price cap. In such case, it's just adding 20 million allowances to the market. And then there is an auction price comparison. So if for more than 3 consecutive months, the average auction price is 1.5 times the average auction price of the preceding 6 months, 50 million allowances are released. And after 2 years, the auction price needs to double instead of having a 1.5 kind of full price figure. Should the price be 3 times higher for 3 consecutive months compared to the previous half year, this release volume then triples to 150 million allowances. That's substantial volumes. Do we expect this to happen? Well, our modeling actually shows that the absolute price level trigger is very, very difficult to reach, and is very likely to not be triggered. So we do believe that we see the 20 million tons coming to market during almost any given year, kind of because we are expecting prices above the 45 euro per ton absolute price cap. And then we do expect that the TNEC will actually drop below the lower threshold in 2029, which then results in a TNEC-based trigger, like release of allowances during the years 2030 and 2031. But then the allowances in the MSR will get invalidated. So as you see on the lower chart, we're basically still having 440 million allowances in the MSR that we expect not to be reaching the market and then not being available going forward. Okay, a lot of architecture. Let's look at prices. So on the left side, you see the market balance. In the middle, you see our base case price forecast. And on the right side, you see fuel price changes as a result of the ETS2 price forecast. The balance, as you remember from earlier in the presentation, turns tight quite quickly. This leads to ETS2 prices increasing sharply during the first years. So from 80 euros per ton in 27, 180 euros per ton in 2034. And then afterwards easing again as the fleet conversion and technology adoption in transport and building sectors has an effect, as I explained before. Rising ETS2 prices means fuel prices will also jump, especially in countries with lower fuel taxes like Poland and Hungary, for instance. So on the right side, you see kind of percentage changes of fuel prices in comparison to the base or to the VAU, I should say. So petrol could see up to 22% increases by 2030 in Eastern Europe. This dynamic explains why policy and technology support are quite crucial. So if clean tech uptake fails, if member state policies working alongside the ETS2 framework are not ambitious enough, compliance costs will rise and price pressure will intensify. And I think this is obviously a very big political dimension, especially ahead of national elections, which then causes a bit of counter kind of rhetoric that we have seen from quite a lot of member states lately. Yeah, we obviously track all these price signals in real time on our analytics platform, so having quite an informed view then on how this is developing over time. Before we close, I just wanted to point to a recently leaked non-paper, which is typically a way to air ideas by member states without kind of putting them formally into a debate. But so far, 16 member states stand behind, including Germany, Italy, and Spain, so also quite a few heavyweights. And this non-paper proposes 5 adjustments to the current policy framework. So there is a constant discussion on, do we actually need to do something to the system before it has started? Because it is having some political impact, especially when it comes to fuel price changes that I mentioned before. So those proposals range from better available information, early auctions, MSR changes. So really from like, in a way, easy to implement measures to then really architectonical changes to the market framework, right? So we have used our ETS2 in-house model to assess the impact on supply-demand balances and obviously also on prices. And especially the proposed redesign of the MSR could have substantial impact on market outcomes. I think what we have to say here is that removing the clause that cancels all allowances or that invalidates all allowances initially placed into the reserve from 2031 onwards, that I described before, which is one of the 5 proposals, could drive the carbon price down to just under half of our base case projection in the early 2030s. It's a massive change that is proposed here. What is fairly obvious with this exercise is that a good understanding of the political and regulatory landscape, coupled with like our kind of fundamental modeling abilities to then kind of identify actually the impact, is quite crucial to prepare for the start of ETS2, because this is something that everyone in the market needs to understand when positions are taken. I think we have covered quite a bit of ground here with regards to the different kind of political considerations around the regulatory market framework, looked into price levels, looked into our view and how we think this market is going to develop kind of price level wise. I think there is a lot of, well, practical at-hand questions that are quite burning. So I'm transferring back to you, Jens. I think we'll have an interesting discussion around this now.
We will. Thanks a lot, Marcus. Great introduction. And I think simplified, on the one side, we have clearly a political dimension of the acceptance of the system and the ambition it puts as well on adoption to this. I think to industry, to households, to basically everyone involved. On the other side, there is a very market design, let's say, very technical way of looking at the market and how it develops. If I get you right, starting on the highest level, you don't expect that while there is countries like Poland or France being very outspoken, you don't expect that there is decisions made on a European level further delaying ETS2 or changing it fundamentally. Is that correct?
I think there's different ways to make changes here, right? So I think a cancellation that has been discussed before in the political arena as well. So let's cancel this market, is way too complex and kind of impacting households way too much. I think that's the chances for that are extremely low that this will happen. I think what we have seen, especially with this non-paper being put on the table now, which has support of a large number of member states, there is a rather constructive dialogue going on the political levels now on how to make the system a bit more digestible, I think, especially in the start period, with proposing changes to the market architecture. But also here, I have to say that, I mean, calling for early auctions, right? Looking into the MSR rules, having a look into how changes to those to those measures would impact the market, all good. But looking then into the political reality on basically touching, even if it's not ETS directive touches, right? But if you have to touch some of the underlying regulations and decisions, most of those measures will most likely also require the ordinary legislative procedure, which involves parliament, its committees, as well as the council, quite a lengthy process that then usually ends in these trilogue negotiations that all of you probably have heard of before. Even if we do this in a very, if this is done in a very speedy manner, it will likely take more than a year or so to conclude, right? So even if there is intention to change and amend the rules, it's not a given that this is happening ahead of time before the system starts. So I remain a bit skeptical that even though we have the addressed will now to make amendments, that the practical implementation will actually take place.
So we have to deal with a lot of insecurity for a while. There's not a certain date where we know this is now coming. There will be continuous discussions probably till very close till the start. Yeah.
Well, I would say we know when there is a formal proposal on the table, right? Then we know what exact procedure has been chosen, and then we can also make quite an informed estimate on how long it will take to implement, and then have a view on the likelihood of this. But what I would say is that we have to, all of us, I think, have to work under the assumption that things are coming as they are currently in legislation, because we have not seen any formal legal or legislative proposal to change this. Yeah.
Look, what there's discussions on European level. If you look, let's say, for example, in Germany, it's pretty damn silent. We have not the feeling that Germany is ready or getting prepared for this in any means. Is there, from your angle, can you maybe clarify a little bit the roles of the EU Commission on the one side, and what is the role of the individual governments and countries in the system?
Well, it's twofold, I would say. So I mean, from like a European level, everything is clear, right? We have the directive change, we have some regulation changes that are especially directive change needs to be transposed into national law. So this is a it's not a choice. It's a must that the member states have to transpose into national law. But we have seen some delays with regards to this happening or not happening. So there have been infringement procedures opened against a high number of member states, which are now kind of successively getting close.
Yeah.
The more those member states actually following on the transposition pathway. So this is a mere formality, and we are going to see see this gap being closed over time towards market start. I think what's probably the even more important requisition for member states is to, in addition to the ETS2, have a view on which kind of adjacent policy measures are required in order to bring down emission pathways in the sectors affected. So to help those actors in these in these sectors to actually embark on an abatement trajectory, which means either by subsidies or by means of other incentives to allow kind of to ease the installation of heat pumps, to kind of foster a transition and fast track the transition towards battery electric vehicles. This is member state policy. This is not coming from the EU. And I think this is where each and every member state basically has the cards in their own hands to move fast or slow.
But the money comes from the ETS2, or where does the money for subsidies and social smoothing comes from?
Well, I mean, there's different pots that you can use for this. I mean, ETS1 is another probably big contributor to this. So there is ring fencing within these mechanisms that are requesting member states to use them for fast tracking kind of the carbon reduction pathways. There is a big social climate fund which is going to be funded mostly through auction revenues in the ETS2, but also cross-funded by ETS1, which is then available to member states to invest in policy measures. So I think there is plenty of instruments that member states can use, but in the end, it depends on the policy framework that needs to be in place in order to also channel the funding into the right direction.
Mm-hmm. All right. You described that the adoption path needed or triggered by the market is highly ambitious, and therefore as well up to political debate. And is this realistic or is it not? Maybe starting from the structure, it's basically one price for 3 different sectors. Do you have a view on the different elasticities we will find or reactions we will see by these segments, given the impact on prices for consumers we can foresee here? That was one question of participant.
Yeah, look, I mean, this is it's an interesting question, because the question is who in the end faces the cost, right? So I think, and this is where there's a fundamental difference between the ETS1 and the ETS2. The ETS1, the EU ETS, is basically targeting the emitters straight away. So this is where you have a direct carbon price to abatement relation, which then is also something that is obviously important when it comes to investment decisions and kind of taking into account the carbon price in those decisions when you look into your profitability of your abatement measure. And the ETS2 is different. So you're putting the carbon price on the basically on the distributor of the fuel, but the actual abatement action needs to take place on the end consumer side, right? So you have a carbon price that needs to be funneled through the distribution side, which is in a way required to pay that price, but then kind of needs to reach the end consumer. And this is what I meant with, in a way, the adaptation friction when we talk about the abatement measures to basically getting realized. You have a carbon price that needs to incentivize someone at the pump, for instance, to then invest in a battery electric vehicle, right? So this will most likely not only be the carbon price at the pump, but also adjacent measures and support that then kind of drive those decisions in a bit faster manner.
Yeah. And what would need is actually price signals triggering these adoption processes, which we don't have.
Yeah.
So maybe transitioning a little bit to the market perspective, you said one idea is maybe having even the auctions earlier, already in 26, to produce these price signals earlier, I guess. That would be one adoption we could envision, no? That
Well, I mean, look, I mean, first of all, it's not my idea, it's from from the bond paper, right? So that needs to be clear. So that was what member states suggested. Look, I think we have a price signal. There is contracts out there. There is a price signal. It's a question of liquidity, right? So I think the problem that the market is in a way currently facing is that despite a price signal, there's not a lot of trading activity going on because obviously the seller is taking the risk of non-delivery in case there is the one or other regulatory complication that needs to be somehow like accounted for. So if you open kind of a short position right now in this market, you're running a certain risk that you can't hedge against like a physical delivery necessarily, right? So an early auction would basically change that because you would in a way start to hand out physical allowances to the market at an earlier stage, which then also basically mitigates the risk of non-delivery, or at least reduces it quite significantly. That said, especially when it comes to early auctions, I do see quite some complication on the policy regulatory side with regards to implementing this without addressing it somehow in the ETS directive. And directive changes, as said before, are complex and complicated.
Yeah. We get quite some questions here regarding really actually trading ETS2 certificates. One question is regarding the regulatory status. These are financial contracts, financial derivatives, at least if traded as a future, not in the spot market. Is that's I think the common interpretation, or no? There's no doubt. There's as well questions regarding enmacc, how we deal with this. So I'm clearly happy to say that we get ready. We are technically ready or ready to launch it. We will offer as well the opportunity to trade ETS2 on the platform as financial derivatives if we talk about forward or future trades, clearly. So it requires all market participants to be ready for financial trading, getting in touch with us, the KYC, and as well some internal processes up to speed and some rules established. That is a needed fact to participate in this market while being it on exchange or in the OTC world on enmacc. So I think it's again one more call to everyone get ready and be prepared for these needed steps of preparation. The liquidity you said is rather low, and teasing you a little bit, you showed it as well in one graph with the ETS1. Is there any connection in terms of price levels we can expect? Sure, they will move up and down a little bit in parallel. I guess there's some correlation, but in terms of level, we can expect that this is a totally different market, no?
Yeah, I mean, in a way, by the name of it, I would say it's a comparable commodity, which is carbon. It's a ton of carbon. But the cost for the ton of carbon is basically a result of the abatement or the investments in the abatement technology required, which is, by the way, the reason why there is two different systems. There was a political risk, I think, seen very early on that combined or like basically doing this as a scope extension to the current existing EU ETS was seen as too risky, given the unknown nature of the abatement costs in the sectors covered now by the ETS2. So there is no direct link between these two markets. Hence, it's also difficult to use the ETS1, in my view, the ETS1 and the EUAs as a hedging instrument against ETS2 allowances, even though at the moment price levels are rather similar or moving a bit in tandem. There's a clear intention on the political side to assess a linkage between those two markets down the line. So there is, I mean, it's even mentioned in the ETS directive that by October or by 31st of October 2031, the Commission needs to put forward an assessment of linking the two systems, whether there is a reason for discussing this. So I think the clear intention is to move and develop those markets in parallel. and discuss linking at some point, but for the moment they are separated.
Great, very good. Looking again into the questions, and I'm happy that we received so many. Try to address most of them. Yeah, we maybe around the liquidity of the market. We have seen a few trades from our discussions. We do see that large utilities as well as banks are getting ready and try to formulate a known view on the markets. And I think they will be ready, would be here at least beginning of 26 to provide liquidity as well to, let's say, Stadtwerke, other smaller kind of buy-side players in the market. That's a little bit what holds us still back, that at the moment we feel the market is not ready to provide these prices sufficient liquidity in the market. So Q1 26 latest, I think we may see their wide readiness. Is this as well aligned with your expectations?
Well, I mean, I would consider the current period as test and learn in a way, right? So it was the same for the EU ETS as well. I mean, there is a possibility to trade allowances at a very early stage right now. It's a possibility to test the trading infrastructure. It's a possibility to test kind of how counterparties are set up. It's a possibility to get all the contracts in place. I think what we have seen so far in terms of liquidity is a signal: we're here, we are ready, we are kind of we consider us as serious market participants in this. And I think that this period will continue to kind of to attract a few more trades. I think given the volume that we have seen, it's not really taking a huge risk here, or like building up a large position. It's more to kind of use the infrastructure that we currently have to indicate this. I think this is quite important. It's an important possibility now to basically get ready for this market when it takes off. I'm an analyst, but I'm probably still I'm probably slightly more skeptical with regards to liquidity in Q1, at least in forecasting when liquidity will pick up. I do think this really depends on whether there is the right price level that unlocks the sell side to take a bit more sizable positions, because in the end it's a consideration of how much risk am I willing versus the margin that I might actually get out of my trades. So knowing that the market starts with an oversupplied situation, I think we need to see a price level that unlocks the sell side, taking into account that prices might drop slightly again towards the market start when the physical allowances enter the market. So I think it is probably more driven by that than necessarily by a specific date.
Yeah, and maybe because we got some questions here, a few words from you on this specific market structure, so that we have these kind of primary market auction mechanism, and then we have the secondary market somewhere else, maybe on enmacc or on enmacc as well, and other OTC markets. Can you explain that maybe with a few words to get clarity in this kind of specific market structure we'll face? Because
yeah,
many of the smaller participants can clearly not participate on the exchange. That's background.
Yeah, sure. So I think there's different trading possibilities that you can, or trading avenues that can be used. I mean, first and foremost, again, primary supply of allowances will happen through auctions. So you can participate in the auction platform that is then kind of pushing those allowances into the market and getting them basically directly sourced. That will also mean a physical delivery to your account. And then there's typically, I mean, at least looking at what happens in the EU ETS, and there's a huge secondary market, and this can either be exchange driven or a broker market, where kind of the allowances or the contracts, the financial contracts are traded, which basically means if you, for instance, trade a December 27 contract, you would enter kind of into a position or into a contract at a given price today, but physical delivery will not happen before then expiry date, in this case then December 27. So you can roll over those contracts and basically work them as financial structure, or you lock them in as physical contracts. And then I guess on the broker side, this is a bit more of a bilateral setup, where you very often use auctions, where you very often use exchanges as clearing houses in the background, but you're trading your allowances via a broker. And then I guess you probably have a few other revenues, Jens, that you can talk about from an enmacc perspective.
Yeah, like I guess we sit there next to the brokers in a way, but I'm simplifying saying I think will happen exactly as the ETS1, which is already actively traded on enmacc. So there's a lot of parallels in this. And yes, it will engage more participants in the market. More people are concerned or addressed by the ETS2 now. So it's definitely a wider pool of companies which will participate on a wholesale level. That's at least our expectation in this. And yeah. Price finding will happen clearly on the secondary market on exchanges as well, but usually we see that, especially the RFQ trading on enmacc is as well quite suitable for price discovery in these kind of early stages of the market. So we do expect quite some volumes from the beginning. Yeah. All right. I guess we come to an end. Thanks a lot. Marcus, was a big pleasure. I somehow sense already that it's not the last time that we have talked about ETS2. So there's some updates needed from you next year latest. Hopefully we see some first prices already and have clarity on the regulatory side. Whoever is interested in learning more may reach out to you regarding prices, getting market access and readiness, may reach out to us, to the enmacc team. Happy to help. And yeah, I think we are putting out as well a small survey to all participants, which we would like you to participate if you have time and interest, giving us some feedback where you stand right now in your thinking and your preparedness for this market, which is about to come. Thanks everyone for participating. We had a great audience. I think, yeah, close to 500 participants. Amazing. Thanks a lot, everyone, and hope to see you all soon back. And again, big thank you to you, Marcus, for running this show. Thanks.
Thanks, Jens. See you. Bye.